This is going to be the most exciting 8 minutes on life insurance you've ever experienced. Now, modern life insurance has all sorts of bells and whistles that you can creatively customize a plan for a client. So I'm going to do a case study. If I was teaching a group of agents that I used to do when I was a trainer, this would be about a 3-hour class. So I'm going to try to get it condensed down to 80 minutes. Anyway, so I have a client. He's actually a Medicare client. He's single. He's divorced, 2 adult children, age 66. He's in relatively good health, but he has type 2 diabetes, controlled by exercise and diet. He recently inherited $350,000 from his father's estate. It's non-qualified money, so it's not an IRA or a pension or anything like that. Right now it's sitting in a money market account, earning nothing. He has no debt, roughly about $800,000 in various mutual funds and stocks. I've referred him to JT to look at that. He's not done it yet, but we'll keep working. He's currently satisfied with his portfolio allocation, but may want to reposition assets in the future. His income, he's got plenty of income right now with no debt. He works part-time as an architectural consultant. He's deferring his Social Security to age 70, and to maximize his Social Security income, he's probably going to retire in the next 5 years or so. So his goals are to leave a little nest egg for his kids, to be able to cover nursing home expenses so that he won't be a burden to his children. He does not have long-term care insurance for nursing home. He wants to use $50,000 of that $350,000 to upgrade his home, but he wants to position his that inheritance in a low-risk environment. And I already mentioned he wants to retire. So, my proposal is you take $300,000 and you reposition it into a single premium life insurance contract. It's indexed universal life. What does index mean? It means that the returns inside the policy are indexed and tied to a stock index, in this case the S&P 500. So if the S&P 500 goes up 10 points, he gets 10 points or 10% credited to his account. If it goes up 20, he only gets 15 because it's capped at 15. If it goes down 20 points, he stays level. He doesn't lose any money. So it's very, very safe. So the trick is, most people don't like life insurances because, first of all, they're front-end loaded, which means that you pay for it up front and you lose money right up front. So what we're going to do in this is waive the surrender charges. They also have a rider. This is a company that is a A+ rated company, over a century in business, and they have some riders. It says if he has a heart attack, cancer, stroke, kidney failure, or major organ transplant, he can access some of that death benefit while he's still alive to cover expenses. So if his medical insurance doesn't cover some of those expenses, he can take money ahead of time, tax-free, from his death benefit. Now, it's obviously going to reduce the death benefit for the beneficiary at some time in the future. He also can access this, accelerate the death benefit if he goes into a nursing home and he can't perform 2 of the activities of daily living. Activities of daily living are continence, bathing, toileting, dressing, eating, transferring, or if there's a cognitive impairment. If he can't do 2 of those things for 90 days, he's considered chronically ill. He can access money from that death benefit to help him pay for his expenses to have a nurse come into his home or move into a nursing home. And he can also access that death benefit if he gets a terminal illness diagnosis or prognosis, which means life expectancy of less than 24 months. So when I was at New York Life, we had a rider just for the terminal illness part, and we had a guy who had a liver problem. He needed a new liver. His health insurance didn't pay for an organ transplant. So he accelerated $50,000 out of his death benefit, bought himself a new liver, and as far as I know, he's still alive today. So I've made some assumptions on this policy. 6.69% crediting, interest crediting rate annually based on the performance of the S&P 500 stock index. Current mortality and expense charges will remain the same throughout the life of the contract, which we can't guarantee. So let's just look at the last page. So you can see in column 1, or column 3, I guess, at the end of the year 1, he's moved $300,000 into this contract, he immediately has a death benefit of over $500,000. So if he walks out the street and gets run over by a TriMet bus, his kids will get $556,214. Tax-free. Just remember that. So let's say he's moving along, going through life, and he starts to slow down, let's say at age 80. Now, looking down to year 14 at age 80, he's got $712,000 of death benefit. This is a bucket of money that he can use if he gets chronically ill, if he has critical illness or terminal illness. Okay? Or, and a lot of reasons, the biggest objection to long-term care insurance is that if I pay these insurance premiums over the course of my life and I never go into a nursing home, I don't get any benefit from it. Okay? One way or the other, if he lives, if he dies, if he goes into a nursing home, he's going to be able to access this benefit. And if he keeps going until age 90 and he never uses a nursing home benefit, doesn't pull any money out, he's now got over $1 million tax-free going to his beneficiaries. And notice the net surrender cash value, the account value year one, those account values and the surrender values are the same. We didn't front-end load this sucker. Okay? So this is a way so someone can reposition an asset, have access to their cash, have an immediate death benefit, and have protection in case they get sick, which is likely as they age. Questions?
Maybe I missed it, but pre-existing conditions, like you said you had type 2, is this tiered price?
It is medically underwritten,
okay.
But with this particular company, a person can be rated up to what is called a table C. In other words, they're pretty ill. I can shave that down to a standard issue contract.
So this is a way for people who normally wouldn't be able to get that kind of insurance that you get.
Exactly. Okay.
What if you also already have a product like this with a different company? Are you able to switch it over or move it over to your services?
Yes, you can, but you'd have to go through underwriting. Anytime an insurance company takes on risk, they want to know what that risk is. Insurance companies don't mind buying risk. They don't want to buy a claim. Any other questions? Wasn't this exciting? Yes! This is a big deal. So if you know anyone who has an asset, they'd like to have it work for them, have them give me a call. Rod Augustine, Augustine Finance Services.